Official estimates released recently show India's GDP grew 6.1% in the fourth quarter of 2022-23. The higher-than-expected growth lifted the full-year growth to 7.2%, rendering almost all projections pessimistic, including those of the Reserve Bank of India, (RBI), which had predicted 6.8% growth. Let us explore what factors caused this growth and explore whether India can sustain its momentum. Many factors boosted growth in the fourth quarter of the year. Firstly, agriculture saw an exceptional 5.5% growth, driven by bountiful output in Madhya Pradesh. Secondly, net exports contributed significantly, powered by buoyant service exports and a 4.1% reduction in imports. Thirdly, the production of both passenger and commercial vehicles witnessed a strong rebound from the chips shortage crisis. Fourthly, there was a remarkable recovery in air and rail traffic due to post-lockdown travel demand. The fifth factor was the boost in construction-related sectors like steel and cement, triggered by the government's capital expenditure push in the union budget, causing an 8.9% growth in the gross fixed capital formation. Lastly, the sixth point includes the overachievement of sectors like services, construction, trade, hotels, finance, and real estate, along with the positive impact of lower crude oil prices on economic activities. Finally, the growth figures were no doubt helped by a low statistical base from the peak COVID-19 year. Experts have also ascribed part of the buoyancy to methodological issues proving favorable, such as the Central Statistical Organization's (CSO) use of single deflation rather than double deflation, which, they reckon, tends to lead to overestimation in growth during times of falling oil prices. But these issues should not make us overly skeptical for two reasons. One, the methodology, with all its shortcomings, is followed consistently by the CSO. Second, the estimates are provisional and over the next 2 years will be refined by the CSO as per its policy. In conclusion, while the economy has rebounded from the shock of COVID-19, the key concern now is whether the fast growth is sustainable. Most economists project a slowdown in the momentum in FY24. This is because a red flag tempering the good news for the fourth quarter is the tepid 2.8% year-on-year growth in private consumption, which could be a sign of a slowdown in response to the RBI's monetary tightening. It's early days, though, and the revisions to this figure will have to be monitored. This is important because private consumption will eventually determine private investments growth, which is key for job creation. The emerging global economic conditions will remain an important determinant along with the monsoon and other climate-related variables. But it cannot be understated that the biggest effect may come from policy responses. Sound policies will help the economy sustain its momentum. The recent growth estimates, acknowledging possible revisions, reveal that the COVID-19 pandemic resulted in a major economic shock, reflecting a meager CAGR of 2.7% from 2019 to 2023. The impact of the lockdowns is evident, with agriculture outpacing manufacturing growth due to factory closures, thus necessitating an urgent revival of the manufacturing sector to maintain India's economic momentum.